For generations, Americans have been told that renting is equivalent to throwing money away. But in 2026, entering the housing market without a clear-eyed look at the math is the quickest way to land in a wealth trap. The drive toward homeownership is a deeply powerful cultural force. 65% of people say they pursue a home primarily for the emotional peace of mind it supposedly provides. That emotional need is usually backed by the financial assumption that a 30-year fixed mortgage is the most reliable path to building a net worth. To make a smart move today, you must separate the emotional decision of building a life from the technical investment decision of compounding your capital. Confusing these two motivations, treating a high-overhead lifestyle choice as a guaranteed financial gain, results in the largest erosion of personal wealth in the modern economy. In the 2026 housing market, the purchase price of a home is merely the starting point of a continuous financial drain. This chart shows the rising cost of the hidden ledger. Beyond the mortgage, the average homeowner now spends $15,979 every year on three specific categories: maintenance, insurance, and property taxes. Maintenance is the heaviest burden. Owners spend nearly $11,000 annually on basic upkeep and unpredictable repairs, costs that are zero for someone signed to a lease. Insurance premiums are also volatile. In major coastal markets, they have climbed 48% in just the last 5 years, rising nearly twice as fast as average incomes. Property taxes add a final layer of pressure. As local governments reassess home values, this expense grows perpetually, regardless of the owner's ability to pay. These combined expenses are increasing by nearly 5% a year, while a mortgage remains fixed and household incomes struggle to keep pace. Owning a home functions as an unpredictable second job that siphons away cash flow, often neutralizing any appreciation the asset gains over time. The most significant factor in this equation is opportunity cost, the wealth you lose by committing a massive amount of upfront capital to a down payment. Take a typical scenario. Purchasing a $400,000 home requires an immediate cash commitment of $80,000. This graph tracks that $80,000 if it stays locked in a house appreciating at the historical average of 3.4% per year. After 3 decades of growth, the homeowner is left with $218,000 in equity. If that same $80,000 is placed in the S&P 500 at its historical 10% average return, the growth curve changes entirely. Over 30 years, .Liquid portfolio reaches $1.4 million, dwarfing the returns of the physical house. The renter achieves this while avoiding interest payments, rising taxes, and the cost of a new roof, which allows them to invest even more on a monthly basis. Tying up liquid capital in a physical structure limits a family's long-term wealth ceiling compared to the exponential growth of the market. While the math favors the market globally, your decision has to be made locally. National housing averages are effectively useless for your specific situation. You must calculate the 7-year break-even timeline, the point where the total cost of ownership finally becomes lower than the cost of renting in your specific zip code. This map illustrates the divide. In Midwest markets like Columbus, the gap between rent and a mortgage is small enough that buyers build equity and break even in just a few years. But in coastal cities like San Jose, the price of entry is so high that renting saves a family $4,000 every month compared to the cost of a mortgage. Because banks front-load interest in the early years of a loan, homeowners who move before reaching that break-even point walk away with almost no equity after paying closing costs. Following the emotional myth of ownership while ignoring local data often leads to a massive, avoidable loss of capital. Given the risk of losing thousands in closing costs by moving too early, many now use the 2-year rent trial strategy before committing to a purchase. This period allows you to verify a neighborhood's commute and culture without the financial anchor of a mortgage or the risk of immediate, high-cost maintenance. If the local math allows for it, buying remains a powerful way to establish roots. There is undeniable value in community stability and the ability to customize a permanent family space. Those emotional benefits must be weighed against the strategic advantages of a lease: geographic flexibility, zero maintenance anxiety, and the ability to keep your capital growing in the market. In 2026, choosing to rent is a strategic move to prioritize liquid wealth and financial freedom over the heavy, rigid costs of homeownership.